Housing starts just fell 15.4% in a single month. That number came out this week. Most financial headlines buried it under peace deal celebrations and Fed drama. But that one number may be the most important data point released all week, and it directly affects where you live and what you pay to be there. Let's talk about what actually happened. Every month, the government tracks how many new homes and apartment buildings break ground in America. It is called the Housing Starts Report. When that number rises, construction is healthy, supply is growing, more homes and apartments enter the market. When it falls, the pipeline of future housing dries up, and what enters the market months from now shrinks significantly. This week's report showed housing starts dropped 15.4%. That is not a seasonal blip. That is a structural signal, and the source of that drop makes it even more telling. The biggest damage was not in single-family homes. It came from multifamily construction. Multifamily means apartment buildings, the kind of housing that millions of renters depend on. For the last 2 years, the multifamily construction boom was the only real relief valve in the housing affordability crisis. Developers were building, new apartment supply was hitting cities, rents in some markets were actually softening. That trend just took a serious hit. When multifamily starts collapse, the pipeline of new apartments narrows. 6 to 18 months from now, fewer units hit the market. Vacancy rates tighten, landlords gain more pricing power, and rents start climbing again. This is not a forecast pulled from thin air. It is a pattern that has played out repeatedly across the last 3 decades of housing data. Now here is where things get more complicated. The housing starts number did not fall because demand disappeared. Demand for housing in America remained significant. The number fell because building is expensive, and getting more expensive. Developers are looking at the same economic environment you are reading about right now. Construction financing costs are elevated, labor costs are elevated, materials costs remain sticky, and the macro picture shifted dramatically this week. The Federal Reserve held rates steady at Kevin Warsh's first meeting as the new chair, but the signal coming out of that meeting was hawkish. 9 Fed members projected at least one rate hike in 2026. The probability of a hike by year-end jumped to nearly 90% on futures markets. That is a dramatic move from just 59% the week before. For developers trying to finance a 200-unit apartment building, that shift in rate expectations matters enormously. The cost to borrow money to fund construction rises. The profit math on new projects deteriorates. So developers pause, or cancel, or scale back. And that is precisely what this week's data reflects. If you enjoy breaking down markets and money, subscribe for future updates. Here is what makes this moment particularly uncomfortable. The Federal Reserve's hawkish pivot was partly triggered by a strong labor market rebound, the same labor market strength that historically supports housing demand. So you have a situation where Americans have jobs, they want to rent or buy homes, but the supply of new housing is pulling back, and the cost of mortgages may be heading higher. That is not a housing recovery story, that is a pressure cooker. On the buyer side, the math is already stretched. Mortgage rates remain elevated relative to a decade ago. A potential Fed hike pushes those rates higher still. Affordability for first-time buyers deteriorates further. The dream of homeownership shifts from difficult to genuinely out of reach for a larger slice of middle-income Americans. But the renter story may be the one that hits hardest and fastest. Roughly 1 in 3 American households rents their home. Many of those renters are in markets that benefited from the multifamily construction wave. New supply coming online was giving tenants leverage, the ability to walk away from a renewal and find something better. That leverage depends on there being something better available. When the construction pipeline shrinks, that option disappears. Landlords in tight markets historically do not lower rents when supply falls. They raise them, and the renters with the least financial flexibility absorb the shock first. Now consider where this sits inside the broader economic picture this week. The Empire State Manufacturing Index came in at 5.7. The market expected 13.2. That is a significant miss. Industrial production rose just 0.1% in May. April's strong 0.9% reading is already becoming a memory. The economic data is softening on the manufacturing and production side, yet the labor market is holding firm, and inflation has not fully retreated. The Fed is in a position where cutting rates would risk inflaming price pressures, but keeping rates elevated is quietly crushing the housing supply Americans desperately need. That tension does not resolve easily, and it does not resolve quickly. Here's a practical way to think about what this means for you, depending on where you sit. If you are a renter today, the next 12 to 18 months may become significantly more expensive. The supply cushion that moderated rent growth in 2024 and 2025 is thinning. Building up emergency savings now creates options later. If you are saving toward a first home, this data does not necessarily say stop. It says be realistic about timelines. A potential rate hike environment means waiting for the perfect moment may cost more than acting at a practical moment. If you already own a home and carry a fixed rate mortgage, you are genuinely insulated from the rate risk. Your payment is locked, but the value of your asset in a supply-constrained market remains supported. Limited new housing supply historically does not punish existing homeowners. It tends to support their equity. If you invest in real estate directly, the multifamily pullback creates a more complicated picture. Tighter supply raises rents, but financing new acquisitions gets more expensive if the Fed hikes. The calculation shifts toward managing and optimizing existing holdings rather than aggressive expansion. The part of this week's news that deserved far more attention was not the peace deal rally on Monday. It was not the Fed's rate hold on Wednesday. It was a quiet piece of data released while markets were celebrating. A 15.4% drop in housing starts, driven by a collapse in the very segment of construction that millions of everyday Americans were counting on for relief. The housing affordability problem in America was already difficult. This week's data made it structurally harder to solve, and with the Fed signaling it may tighten further, the conditions for a meaningful supply recovery are not improving. Next week, this market will look different. Make sure you are watching.